Hey everyone, thanks for tuning in to 15-Minute Finance. Today we're going to be going over Tencent. So Tencent is basically, in the most simple terms, the Berkshire Hathaway of China. They focus primarily on tech stocks. So right now they run WeChat, which is the most popular messaging app in China. They run Tencent Entertainment, which controls about 65 to 75% of the movies and music that comes out in China. And then they also are one of the biggest video game publishers in the world. So they own fractions of a ton of different video game companies that you're all familiar with. So basically what they do is they'll take stakes in a company or buy out the whole entire company and then just basically run the business and cash in on their investments returns. So they are very much similar to Berkshire Hathaway in that way. Some of the investments that are more popular and you might be familiar with, and they might actually surprise you to hear that Tencent owns some of these companies, is Snapchat, Tesla, Fortnite, Riot Games, Epic Games, Universal Music, Spotify, Ubisoft, Activision Blizzard, and their entertainment arm has actually helped to produce the new Top Gun and Wonder Woman movies. So just taking one of these investments on its own would be a home run, but to be involved in all of these, it's truly showing how good of a company this is and how intelligent they are with their money. But again, being a Chinese company, not many people might have heard of them, but they are involved in some of these huge investments that everyone has definitely heard of. Quickly looking at the company overall, it's trading right now at a forward PE ratio of 24, which is extremely low, especially for a high growth tech company like this. It's something that's unheard of in the US market, at least. Like if you look at Apple, Google, Facebook, respectively, they're trading at a 32, a 34, and a 30 PE. So for this company to be trading at a 24 right now just means that it is very undervalued. There was some recent news recently that might have dropped the price, and that has lowered the PE ratio a little bit that we'll get into later. But right now, I mean, it's a really attractive price. PE ratio, if you're just looking at that, a 24 is very attractive to get in on this. Market cap, 724 billion. That's a huge company, again, trading for a low PE. Price right now is $68, again, due to that drop in price that we saw recently. And then the 52-week range is about 62 to 99. So if you're getting in right now, you're really going to hit this company at close to its 1-year low, and it could be a very good buying opportunity for the future. The price chart for this company speaks for itself. In the last 5 years, it's gained 224%. That's a huge amount for a growth company. And right there at the red line, you can see the 2021 numbers. So that's about a year ago. So it's reached $99 at its highest. And right now, like I said, trading at about $68. So this kind of shows that in about 2020, this company really hit its strides. The investments started paying off, and being an investment-focused company, it's going to take some time for those investments to pay off. It's not something that they put out a new product and it eventually just skyrockets. It's something where you're going to have to be a little bit more patient in their acquisition. You have to let the businesses that they're investing into develop and mature, and then that's when you're really going to see the revenue coming from those companies. So looking at the balance sheet, one thing that we're going to have to keep in mind here is that these numbers are in Chinese yuan, so it's not US dollars. In order to get the US dollar amount, what you'd want to do is divide each of these numbers by about 6. So taking that in mind, $1.3 trillion worth of total assets and $555 billion in total liabilities. It's always good when a company can cover their total liabilities once over, but being able to do it twice just really shows that they are in a really good cash position, which this company is in. The cash position of the company isn't as strong as I would prefer it to be for a company that I'd be investing in, but that said, it is still very strong. They can almost cover their current liabilities once over with their cash and cash equivalents. So again, not as strong as a position as the companies I typically invest in, but the growth rate of this company and just their vision overall kind of makes up for that. And still, that being said, they can almost cover their current liabilities with their cash position. So if it were to happen, they could pay it off right away, but again, that never really happens. So it's just kind of a ratio that I look out for, but the fact that they're almost able to cover it once is a check mark in my book. The growth of assets over the last 3 to 4 years has been pretty steady, so it's moving at about a 32% average year over year, whereas the liabilities are growing at about a 24% average year over year. So the assets are outpacing the debt. That's an incredible thing to see. Again, with a growth company, and especially an investment-focused company, they need a lot of growth and they need a lot of cash on hand. So the fact that their assets are just continuing to grow faster than their debt is a good thing, and it means that the investments that they're making when they are spending money, it's not outpacing the growth that they're seeing in their company. So again, this is just another good thing to see on the balance sheet. So cash flow. Cash flow is king, and this company has plenty of it, and it's also growing substantially. So if we actually look at 2019 to 2020, when COVID hit, they grew their cash by a pretty substantial amount. They went from 91 billion to 127 billion in cash flow. So that's an incredible thing to see, and they can use this money to do share buybacks, can fuel the acquisitions, which again is their bread and butter. That's what they need to do to keep growing as a company, or they can fuel dividends. Revenue as well is moving in a pretty good position. So it's not a huge amount of revenue growth. It's about, I think, 25-ish% year over year. But that being said, Tencent is relatively a mature company. I mean, it's not an AT&T where it's been around for decades, but it is not a new growth company. So the fact that the revenue is still getting about 25% year over year is a really good sign. And then the most important thing, and what's really, really good about this company, is net income is growing exponentially. So there was a massive increase from 2019 to 2020. That's about a 70% growth, that 93 billion to 159 billion. So before that, you can see it only jumped from 71 to 78 and then 78 to 93. But the fact that they were really able to hit their stride and get the revenue to the bottom line shows again that these investments that they've made in the past couple of years have really been paying off. The growth of this company kind of speaks for itself. So we've been looking at the balance sheet and income statement, and here's just a kind of year over year and compounded annual growth rate look. So 27% year over year for revenue and 24% over the last 3 years for revenue. Great numbers. They're going to continue hitting them in my opinion, and the investments are just going to continue to grow over time. And EPS, so this is really where it matters to a shareholder, 88% year over year. Again, that's huge, and I think it had a lot to do with that net income getting up 70%. And 3 year is nothing to sneeze at, 30% growth rate for EPS. So that's kind of where you see the gains in the stock price. So seeing that it's growing at 30% and even more recently at 88%, it's only a good thing for shareholders, and especially right now when we're on a bit of a dip. So for those of you who aren't really as familiar with Tencent, you might recognize some of the names that they invest in. On the Chinese side, you really have to look at their key services, and these numbers really just speak for themselves. I mean, in communication, games, content, fintech, the cloud, and utilities, they're all either the number 1 or number 2 position in China. So that's just incredible. I mean, you can liken them to if Google and maybe Apple were to merge together, then this is the kind of domination that you would see from those two, but it's in one company. This is just Tencent. So it's important to also note that they're currently the number 1 and 2 service provider for all of these different areas, but they're also the number 1 and 2 service provider for the largest country in the world with the biggest consumer base. So China's consumer base is not going to slow down really anytime soon, I'm sure. So they're not going to be overtaken in population especially. So just the fact that they're holding down these top spots in the top consumer market in the world at this point is huge for their business. Revenue by segment, looking quarter over quarter, it's a great thing to see it continuing to grow. And then specifically when you take a little bit of a deeper look at these numbers, their fintech and their gaming segments are the ones that are taking more of the revenue share from those other segments, which is kind of what you would want to see if you're looking at this business and you're looking at the growth of gaming and the growth of financial technology in the next 5 to 10 years. So those are going to be huge growth markets. Technology is only going to continue to move into the financial space, which needs a little bit of an overhaul. Think about like Cash App, Venmo. So those are the cutting edge, and it's only going to get more and more efficient over time. So the fact that they're leading fintech and they're able to grow that segment is huge for them. Tencent's recent investor presentation highlighted 3 key segments in which they want to focus on in the future. So the first one is business services, business to business, right? So they want to provide businesses with, 1, a cloud platform that they can use. So think of how Amazon kind of turned itself and started providing Amazon Web Services. And now Amazon Web Services is actually more profitable than the original business itself. It's not an apples to apples comparison, but the point of that is that the cloud business is a huge opportunity, and the more that China kind of digitizes, the more businesses need to get onto the cloud and get onto the internet. And if Tencent is there to capture that market share, then they're just going to make a ton of money off of that. The second focus for Tencent is their gaming section. So I think that this is really the most exciting for them, and it is where they're seeing some of the highest growth. They are already the largest video game producer in the world, and I think that they've really caught on to the trend of, esports. You have mobile video games. You have these free games that you can download and then pay for add-ons. So think about Fortnite, PUBG. And then the year-to-year games like Call of Duty, they're starting to produce a lot more of those. So gaming is only getting more and more popular, and when things like VR come out, they want to be in that space, and they're already dominant in the mobile app space. So the fact that they're willing to focus on these kind of games that have high production value and they have high daily average users is kind of one of the best things that they can do to focus on and really make sure that they keep that number one overall market share in this market. The last one that they focused on is short form video content. So basically think YouTube. So what they want to do is take their short-term video content platforms and their long-term video platforms, and they want to kind of merge them. So let's talk about the risks. The biggest one right now is actually from the Chinese government, which might sound strange because it's a Chinese company. Really kind of a wild card, and you never know what the Chinese Communist Party is going to do, and they're gonna make their companies do. Now, I don't see them putting these huge restrictions on, Tencent, Alibaba, and because they know it'll crush their company, and it's a Chinese company, so they want them to do well. But the fact that they did hit Alibaba with a fine, and it still hasn't recovered back to the height of $300 in stock price, just means that really no one is safe from the Chinese Communist Party, and they can do really whatever they want. And I think that move against Alibaba and then now against Didi was kind of to remind the Chinese companies about that fact. But it is definitely something to watch out for, and it makes investing in Chinese companies a little bit scary at times because you have no idea what's going to happen. And on Friday night they could come out with that kind of news, and Monday morning your stock price is down 40%. So it's just something to watch out for, something to keep in mind, but it shouldn't really keep you from investing in what I would call the safer Chinese stocks. The second is regulation from the United States itself. So if the United States deems that any of these companies are a national security risk, they can immediately delist them on the US stock exchanges. And it will go through a process of appeals, I'm sure, but at the end of the day, there are over 100 companies from China that are just not allowed to be on the US stock exchanges. You can't invest them in. The next risk for Tencent is monopoly, right? So China tends to crack down on companies that they believe hold a monopoly in a space. And if you think back to that chart that we looked at about, how they're the number 1 and 2 provider in 7 different industries, they are pretty much the definition of a monopoly. Now, this is something that a lot of tech companies in general face, and it comes down to, just the relationship that they have with the government and their arguments in court on why they don't represent a monopoly. But it is hard to look at those daily average users across all of those platforms and not think that Tencent holds a monopoly on those different services. The stock is great for investors with that high risk tolerance and that are looking for long-term growth in the future. So it's a great tech company. It's a great market in China. So biggest tech company in the biggest market in the world. It's a hard thing to say no to. And then the strategy that they have, the investments that they want to make, and how they really fuel their own growth as a company is through acquisitions. And they have the cash flow, they have the cash on hand on the balance sheet as well to continue to fuel those acquisitions. And we've seen that, after a good amount of time, you sell 2020, the stock price shot up because they get revenue, the companies that they invest in mature, and you start to really see those investments paying dividends in the stock price. All right, so thank you as always for tuning into 15-Minute Finance. Like and subscribe if you enjoyed the video. Keep your eye out for more videos in the future. I put them out about every single week. So again, thank you for watching. I really appreciate it. And hopefully we'll make some money in the meantime.